One of the oldest market sayings, time in the market beats timing the market. Let's explain why. Welcome to Get Started Investing, a show where we help you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. Always excited. This episode feels particularly timely. Excuse the irony there.
Nice.
Because there are certainly, there's volatility in the market.
There is big volatility.
The US market has technically entered a correction, which is where it falls 10% or more. And people are starting to ask, should I sell and should I wait to buy back in? And we're here to say, remember the age-old saying, time in the market beats timing the market. Don't try and sell and nail the timing back in because you probably won't do it well. You'll probably miss out, and we're going to explain why that is the case in today's episode.
That we are. And before we get into it, a huge thank you goes to our long-term partner here at Get Started Investing, BetaShares Direct.
That's right. On BetaShares Direct, you can build your own investing journey with zero brokerage on over 300 shares and all ETFs on the ASX.
Do you want a ready-made portfolio? Well, there are 10 to choose from, or you can build your own. Automated investing lets you set, forget, and grow. Easy tax reporting, performance reporting, it is all there, unlike any other investment platform in Australia.
Building wealth your way has never been easier. Search BetaShares Direct and set up your account in minutes.
BetaShares Capital Limited is the issuer of BetaShares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you. Investing involves risk. Refer to the PDS for info on other fees and costs.
All right, let's do it. Time in the market versus timing the market. Let's explain why you should pause, do nothing, get on with your life, because that's going to be the best for your long-term wealth.
Yeah.
So let's start by explaining the terms. Time in the market.
I mean, it's pretty self-explanatory. Get invested and keep it in there as long as possible. Don't worry about trying to time when you're putting money in, just get it in there.
Yeah. So time in the market advocates for investing as soon as possible and regularly thereafter, not worrying about the state of the market.
Yeah.
And then compare that to timing the market.
This is where investors want to try and, sell when markets are expensive, and then when markets are cheap, they try and re-enter to try and benefit from these markets rising and falling and avoid market crashes.
Yeah, and here's the thing, the stock market will crash. That is something we can guarantee.
Yeah.
In fact, if you'd picked a random day between 1930 and 2020, there is a 95% chance that the Dow Jones index, so one of the indexes in the US, 95% chance it would have been lower on some trading day in the future. Yeah. So if that's the case, surely it's intuitive to try and time the market, knowing that it will crash again in the future. You know, you hear buy low, sell high. That's like one of the first things you hear
So
as an
annoying.
investor.
Yeah.
And I think intuitively we think we should be able to time the market because we think stock markets are rational and respond logically to the outside world and to changing facts. And
the market is the economy, or
the market
the
is efficient. And so that it's like just an aggregation of all available information, and when information changes, it moves accordingly.
Yeah.
But here's the thing: the stock market isn't predictable.
So there's actually a study done by CXO Advisory called Guru Grades, and what they did was they tracked 6,582 forecasts from 68 stock market experts between 1998 and 2012. And guess what? Their accuracy was not a pass mark. Only 47% of those forecasts were right. And in fact, no guru was above 68%.
Yeah, so no one's batting at more than 2/3 correct.
Yeah.
And these are the experts. These are talking heads on TV and experts that work for investment banks and hedge funds and publish their market forecasts.
Yeah, experts that you, when you start your investing journey, are likely to feel swayed to listen to. Don't.
So, fact number one, stock market isn't predictable. Even the best forecasters don't predict accurately more often than not. They're predicting at less than 50%. Fact number two, if you miss the best days in the stock market, you miss out on most of your return. So this is a Bank of America study that looked at the S&P 500 from 1930 to 2021. And it asked what would happen if you missed the best 10 days of each decade. You know, those days where the stock market jumps 5% in a day or something. For example, in the 2010s, if you just held through the whole decade, you would have made 190% return. If you missed just the best 10 days, you would have got 95% return. So not bad, but not as good.
Yeah.
The problem is also in the down years. So let's look in the 1970s. If you just held through the whole decade, you would have made 17% return. But if you missed just the best 10 days, you would have lost 20% of your money. And so if you stretch it out from 1930 to 2021, if you just held the S&P 500 and done nothing, you would have made 17,715%. That's time in the market.
Yeah.
If you missed the 10 best days of each decade, 28%.
It's wild.
Yeah.
It is wild. If you put some numbers to that, so if you'd invested $1,000 in 1930 and then done nothing, just time in the market, that 17,000% return would have turned your $1,000 into $178,150. If you'd missed out on the 10 best days that Ren was talking about in each decade, you would only have $1,280. Like, it is, you literally cannot afford to try and time the market.
Yeah.
and we go into this in detail in our book.
Yes.
And this stat really, for me, was just like, it just spells it out.
So, fact number 1, stock market isn't predictable. Fact number 2, you don't want to miss those few great days because that will really eat away at your return. Fact number 3, those best days happen at the worst times.
The hardest fact.
So this is research from Hartford Funds that found that many of the best days happen right in the toughest markets. 78% of the S&P 500's best days occurred during a bear market or during the first 2 months of a bull market. So either when the stock market is falling heavily or when it's just ticking up and recovering from that heavy fall. And you can look back at the global financial crisis. The S&P 500 reached the bottom on the 9th of March 2009. And the headlines then were, banks are falling over, there's going to be a double dip recession. But the S&P 500 was up 30% by May and 60% by the end of 2009. So if you were trying to time the market and you were reading the headlines and you thought things were going to get worse, because that's what everyone thought, you would have missed the once-in-a-generation buying opportunity. You would have missed those best days and you would have been really behind.
Yeah. I even think about the COVID bounce and how many people probably tried to time that. I mean, you would have missed that in a heartbeat. But fact number 4, Ren, is that the perfect time never actually looks like the perfect time. And what we mean by that is we've taken 3 of the most recent market collapses, 2001, 2008, and 2020, and we've taken some newspaper headlines from the perfect time, the day that the market bottomed out. Like, if you're trying to time the market, there is no better time to try and get the absolute day the market bottomed. But here's the thing, it was not clear through the news headlines that it was the bottom of the market.
So in the tech wreck, 9th of October 2002, the NASDAQ was down 78%.
Jeez.
This was the time to time the market.
78%.
Wall Street Journal headlines all from that day, 9th of October 2002. Debt woes don't discriminate. Tech stocks close lower and investors seek defensive positions.
Could be any other day.
What do you mean?
Well, or to your point, like there's no indication there that this is the bottom of the market. Yeah.
9th of March 2009, the bottom of the GFC. The S&P 500 was already down more than 50%. Wall Street Journal, tech drop takes down stocks. China warns of severe fiscal conditions. Financial Times, Obama urged to let the banks fail. Like we were still that was still the conversation at this time. Will these banks collapse?
Yeah. And then 20th of March 2020, the S&P 500 was down 31% at this point. It was the fastest fall in stock market history. The New York Times there had a headline: a torrent of job losses threatens to overwhelm the US economy. Coronavirus layoff surge overwhelms unemployment officers. and the Wall Street Journal. The venture market shows sign of stalling, and the Financial Times, US to be swamped by jobless claims.
It's never clear.
It's never clear. They're not going, this is the bottom, guys.
The timing is never clear, yeah. And so let's put this all together. Why timing the market is so difficult. It's near impossible to predict the short-term movements of the stock market. Even the best and most highly paid people can't do it. If you miss the best days, you miss out on most of your returns. Those best days happen in the scariest moments. And those scariest moments are never clear that the worst is over. It always looks like the worst is still to come. So the timing is never clear.
I mean, the facts show if your dollar cost averaged into the US stock market over a 20-year period, you would have been up. There is no 20-year period where you would have been down. That's a stat you should think about when your friend is telling you stocks investing is like gambling as well. And if we have a look at the greatest investor of all time, Warren Buffett.
The greatest buyer and holder of all time.
True. The greatest long-term investor of all time. He's lived through 15 American recessions. But despite all of them, 15 recessions, he has built a multi-billion-dollar fortune. 150, I think. Is
multi-billion seems to be underselling it.
True. 150 plus $1 billion fortune, and that is through long-term time in the market.
Yeah, the market crash is front-page headlines. The market recovery is business news. But the market historically has always recovered and then some, and that's the thing that you've just got to keep in mind. And the reason that we think time in the market is all you need is even if you invest at the absolute worst times, that's okay. So my favorite example of this, you've probably heard it before if you've listened to this podcast for a while, is Lehman Brothers, the investment bank in America, collapsed on a Monday. And that really was seen as the spark of the global financial crisis. If you had invested in the S&P 500 on the Friday before that Monday the 15th of September 2008 to be specific, in the 6 months after, you would have been down about 50% or down 46%. You would have lost about half your money. Not great.
No.
But 10 years later, if you'd held on, you would have more than doubled your money. If you'd reinvested your dividends in that 10 years, you'd have almost tripled your money. And that's investing at the worst time and just holding for 10 years.
So let's bring it back to a scenario that many of us are doing here at Equity Mates and Get Started, and that is just dollar cost averaging into the S&P every month. So if we took $200 a month in the S&P 500 for the last 30 years, you would have invested $72,000, but you would have $469,000. That is 6.5 times the amount that you invested despite the 2021 tech bubble, 2008 global financial crisis, the 2010s European debt crisis, 2020 COVID crash, China-USA trade war, Clinton impeachment. The list goes on. There are so many reasons to get nervous and not invest. But as we've made clear, you cannot afford to not be invested.
Yeah. So that is why time in the market beats timing the market, because timing the market might make sense on paper and as you look back historically, but actually timing the market, actually doing it is, I was going to say near impossible, but I think you could say impossible.
Definitely.
No one has shown an ability to do it consistently well. So
just look at the richest guys in the world, Warren Buffett. I mean, the top 10 richest guys in the world, they are the richest guys in the world because they've owned businesses for decades.
Yeah. Well, I mean, even the best investors, no one is out there advocating market timing. Like, so like even the quants, like even a Jim Simons or someone, like they're not trying to time the market.
No.
But then you look at like investors that we sort of look to, the Buffetts, the Ackmans, the Howard Marks, Munish Pabrais, the whoever it is, none of them have made their money timing the market.
No.
Yeah.
Like
people,
they're opportunistic.
Yeah, definitely. I mean, very opportunistic when markets have crashed.
Yeah.
Don't get us wrong there, but it's the trying to sell out, buy back in. That's the challenge. Yeah.
And I relate to this. When I first started, the number one thing I had in my head that I'd read everywhere, buy low, sell high. number one thing. And I tried to do it, and it was an uncomfortable investing experience. And I think until the faster you can get into this strategy and just DCA and go away, the more confident you're going to feel with your investing.
Yeah. So that's why time in the market beats timing the market. That's why you should get started investing. And that's why you shouldn't panic when markets crash. Well, that takes us to the end of this episode. Hopefully it's helped. If it has, we'd love it if you could leave a rating or review. Make sure you're subscribed wherever you're watching or listening so you don't miss future episodes. And hey, send it to a friend or a family member that might be looking at their brokerage app a little bit too much and needs to be reminded why time in the market beats timing the market. But Bryce, that'll do us for this episode.
Sounds good.